Let me guess. You want to start investing in 2026, but your bank account is looking a little lean, and the whole world of finance feels like a party you weren't invited to. You're not alone. Most people are convinced investing is some complex, secret language meant only for folks with finance degrees or giant salaries. You hear friends talking about stocks and bonds, but it might as well be Klingon. The thought of picking the right investment is terrifying, and you're pretty sure you need thousands of dollars just to get in the game. What if you mess up? What if you lose it all? That fear is powerful. It keeps you on the sidelines, watching other people build wealth. But what if I told you almost everything you think you know about investing is wrong? What if the biggest thing holding you back isn't your wallet or your know-how, but a few myths we're about to bust right here, right now? In this video, I'm going to break down what stocks and bonds actually are in simple terms. Then, I'll walk you through step by step how to open your very first investment account for free, even if you're starting with literally $0. By the end of this video, you will have a rock-solid plan and the foundation to officially call yourself an investor. Let's do this. As a quick heads up, this video is for educational purposes only and isn't financial advice. Every investment has risks, so please do your own research. Hey everyone, I'm Ryan. On this channel, we don't chase money. We build systems that generate it. I break down real wealth strategies, asset building frameworks, and financial truths most people never learn. If you're serious about growing your money the smart way, subscribe now and hit the bell icon. Let's build something that pays you back. Let's tackle the biggest lie in finance. You need money to make money. For decades, that was sort of true. You needed a broker. You had to pay crazy high commissions. And most investment funds made you deposit thousands just to open an account. The system was designed to keep regular people out. But that world is gone. Today, thanks to technology, that entire system has been completely demolished. Think about it. Major trusted brokerage firms like Fidelity, Charles Schwab, and Vanguard now let you open an account with $0. Let me say that again. You can open a fully functional investment account the same kind millionaires use for free. No money down. Many have no account maintenance fees and no minimums to start. This isn't a gimmick. It's the new standard. They've torched the financial barrier to entry. The gatekeepers are gone. And what about buying investments? If a popular stock costs, say, $500 a share, you used to need the full $500. Not anymore. The second part of this revolution is fractional shares. This is an absolute game changer. It means you can buy a tiny slice of that same $500 stock for as little as $1. You don't need a whole share. You can own a fraction of one. So the excuse, "I don't have enough money," is officially dead. If you can find a single dollar, you have enough to invest. The question isn't if you can invest, but when you'll start. Okay, so you can open an account for free and start buying with $1. But what are you even buying? The entire investing universe is built on two things: stocks and bonds. Get these two and you've won 90% of the battle. Let's start with stocks. A stock is just a small piece of ownership in a company. Imagine your friend wants to open a coffee shop. They need $10,000 but only have $9,000. They come to you and say, "If you give me the last $1,000, I'll give you 10% ownership of the whole business." You do it. Boom! You're a shareholder. If that coffee shop takes off and makes a huge profit, your 10% stake becomes way more valuable. You might even get a cut of the profits each year, called a dividend. If the business expands, your $1,000 could turn into $10,000 or even $100,000. That's exactly how the stock market works, just on a massive scale. When you buy a share of a company like Apple or Microsoft, you're buying a tiny piece of ownership in that global giant. You're a part owner. The main reason to buy stocks is for growth. Over the long term, stocks have historically offered much higher potential returns. The trade-off is higher risk. Stock values can swing up and down wildly, which is called volatility. Now, bonds. If a stock is ownership, a bond is a loan. Let's go back to the coffee shop. Instead of ownership, your friend says, "Can you lend me $1,000? I'll sign a contract to pay you 5% interest every year for 10 years, and at the end, I'll give you your original $1,000 back." Now you're not an owner, you're a lender. You've just bought a bond. Companies and governments issue bonds to raise money. You lend them cash, and they promise to pay you regular interest, then return your initial investment, the principal, on a set date. The main reason to buy bonds is for income and stability. They're generally lower risk than stocks because the payments are predictable. Even if the company's profits bounce around, they are legally required to pay you back. The trade-off is usually a lower potential return. So to recap, stocks are for growth, bonds are for stability. A smart beginner's portfolio often has a mix of both to balance everything out. That's called diversification. We know what to buy, but where do we actually do it? You need a brokerage account. It's just an account that holds your investments, like a bank account holds your cash. Anyone 18 or older can open one, and as we said, it's usually free. There are a few account types, but don't let the jargon scare you. Let's simplify. The two main flavors are standard brokerage accounts and retirement accounts. First, the standard individual brokerage account. This is your all-purpose, super flexible account. There are no rules on how much you can put in, and you can take your money out anytime for any reason. If you sell an investment for a profit, you'll owe some taxes, but the freedom makes this the perfect starting point for most beginners. Second, you have retirement accounts, like a 401k at work or an IRA you open yourself. These are built for long-term retirement savings and come with huge tax benefits. For example, with a Roth IRA, you put in money that's already been taxed, but then all your growth and withdrawals in retirement are 100% tax-free. These accounts do have yearly contribution limits. For 2026, the IRA contribution limit is $7,500, or $8,600 if you're age 50 or older. While retirement accounts are critical for your future, a simple individual brokerage account is the best place to start your journey because it's so flexible. So, where should you open it? For beginners, stick with the big, reputable names that have been around forever and charge next to nothing. Look at Fidelity, Charles Schwab, and Vanguard. All three are industry giants. All offer $0 commission trades for U.S. stocks and ETFs online. And all let you open an account with no minimum deposit. Fidelity is often praised for its easy-to-use platform. Schwab has great customer service, including over 300 physical branches. Vanguard is famous for its super low-cost funds. You really can't go wrong with any of them. All right, hit pause for a sec. We've busted the $0 myth. We've demystified stocks and bonds. And we've picked an account. If you're already feeling more confident and getting value out of this, do me a quick favor and tap that like button. It takes you 1 second, but it tells YouTube this is a helpful guide and gets it in front of more people who need to see it. Thanks. Now, let's get that account open. This is where it gets real. You're going to be shocked at how fast this is. We'll walk through opening an individual brokerage account using Fidelity as an example, since their process is so clean for beginners. It's pretty much the same at Schwab, Vanguard, or any other major broker. Step 1. Go to the broker's website. Just go to the Fidelity homepage. Right at the top, there's a big button that says Open an Account. You can't miss it. Click it. Step 2. Choose your account type. You'll see a list of accounts. Don't get overwhelmed. Remember the plan. We want the standard individual brokerage account. Select that one. Step 3. Fill out the application. This is the hardest part, and it's just filling out a form. It'll ask for your name, date of birth, and social security number. This is required by federal law to verify who you are and prevent fraud. You'll also need your address and some employment info. This whole thing takes about 5 minutes. Step 4. Review and submit. Look over the terms and conditions. They're standard stuff. Once you agree, hit submit. In most cases, you'll be approved instantly. Step 5. Create your login and fund the account. Or don't. Set up a username and password. It will then ask if you want to link a bank account to add money. You can do this now, or just skip it. You do not have to put money in to finish opening the account. You can link your bank and leave the balance at a perfect $0. And that's it. Seriously. Congratulations, you just opened your first investment account. You are officially an investor. It probably took you less time than watching this part of the video. The door is open. All you have to do is walk through it. Opening the account is a huge mental win, but it doesn't magically make cash appear. The title of this video is How to Invest with $0, and that's about starting from a place where you feel like there's nothing to spare. So how do we find the money? First, let's redefine investable money. We're not looking for thousands of dollars. We're looking for scraps. We're looking for $5. Strategy 1. The found money rule. Think about the little one-off bits of cash that pop into your life. A birthday check, a small tax refund, the $20 you got for selling an old lamp. Instead of letting that cash dissolve into your daily spending, make a new rule. All found money goes straight into your investment account. You weren't counting on it for bills anyway, so you won't even miss it. Strategy 2. Automate the tiniest amount. This is the single most powerful habit for building wealth. Log into your new brokerage account and set up an automatic transfer from your bank. Don't start with some scary number like $200 a month. Start with $5 a week. That's it, $5. It's less than a fancy coffee. You will not notice it's gone. But after a year, you'll have over $260 invested without ever thinking about it. Strategy 3. The raise diversion trick. The next time you get a pay raise, don't upgrade your lifestyle. Instead, immediately divert the entire raise into your automatic investments. If you get a 3% raise, bump up your transfer by that same amount. You were already living fine on your old salary, so you won't feel the loss. This one trick can add hundreds of thousands of dollars to your portfolio over a career. These small, consistent moves are how you build wealth from scratch. It's not about having a lot of money today. It's about building the habits that create a lot of money tomorrow. You've opened the account. You've scraped together your first $10. Now for the moment of truth. What do you buy? The number of choices can be paralyzing, but for a beginner, the answer is incredibly simple. First, what not to do. Do not try to pick individual stocks. Don't buy a stock just because you like the company or saw it on the news. Trying to pick winning stocks is wildly difficult, takes a ton of research, and is way too risky when you're starting out. Here's a little secret. Studies have shown that over long periods, the vast majority of professional fund managers, the people who do this for a living, fail to beat the market average, especially after their fees are factored in. Instead, your first investment should be in a broad market, low-cost index fund or ETF. That sounds fancy, but it's simple. An index fund or ETF, exchange-traded fund, is just a single investment that holds a huge, pre-diversified basket of stocks. Think of it like a salad bar. Instead of trying to pick and buy every single vegetable yourself, you just grab one big bowl that already has a little bit of everything in it. The most common type is an S&P 500 index fund. This one fund holds small pieces of the 500 biggest, most established companies in the US. By buying just one share or even a fractional share for $1 of an S&P 500 ETF, you instantly own a piece of 500 different businesses. You're no longer betting on one company. You're betting on the entire US economy to grow over time. This is the ultimate beginner investment because it gives you instant diversification for almost no cost. When you're looking for one, Pay attention to the expense ratio. This is a tiny annual fee. You want this to be as low as possible, ideally below 0.10%. Some of the best S&P 500 index funds have expense ratios as low as 0.02% or 0.03%. A low fee like that saves you thousands of dollars in the long run compared to more expensive funds. So your action plan is simple. Put your first $5 or $10 in the account. Search for a low-cost S&P 500 ETF and buy your first fractional share. That's it. You just made your first intelligent, diversified investment. Feeling intimidated by investing is normal, but it's based on an old reality. Today, the walls have been knocked down. We've learned you don't need a pile of cash to start. You can open an account for free and invest with a single dollar. We've learned that stocks are ownership and bonds are loans. We walked through the exact steps to open a brokerage account in less than 10 minutes, and we found the perfect first investment for any beginner. A simple, cheap, broad market index fund. The person you'll be in 10, 20, or 30 years is counting on the person you are today. The journey to financial freedom doesn't begin with a lucky stock pick or a huge inheritance. It starts with opening an account. It starts with automating a $5 transfer. It starts small. You have the map. You have the tools. The only thing left is to take that first step. If this guide helped you, make sure to subscribe for more no-nonsense finance videos designed to put you in control. Now that you have a plan, I'm curious. What's the first thing you're going to invest in? Let me know in the comments below. Thanks for watching, and I'll see you in the next one.